Good day, Gain Squad. The United States Navy just blew a hole in a massive ship's engine room, spiking oil prices back up once again. President Trump just went full throttle on a naval blockade, and the global energy markets are absolutely screaming with volatility. Today on Goldie Gains, we are tracking the explosive naval seizure and the sudden chaos in the Strait of Hormuz. We are analysing the massive oil price gap and why gold is still the ultimate shelter from this geopolitical storm. Plus, we dive into the copper market's red alert and the historic global shift away from the United States dollar. Before we jump in, remember this is just for your info and entertainment, so definitely do your own research first. Here is the big question, traders. Is this the start of a multi-year gold bull run or a geopolitical trap? Let me know your thoughts in the comments, and don't forget to smash that like and subscribe for the squad. Let's see where the smart money is flowing today on this high-stakes Monday morning of April 20th. Over the weekend, the Strait of Hormuz turned into a proper high seas drama that has every single investor on edge. On Sunday, April 19th, President Trump announced that the United States military forcibly seized an Iranian-flagged cargo ship. The vessel, named the Tauska, reportedly tried to bypass the American naval blockade that began only just last week. Trump posted on Truth Social that the Navy stopped them right in their tracks by blowing a hole in the engine. He warned the world that there would be no more Mr. Nice Guy if Iran keeps ignoring the peace deals. This cargo ship is a big one, capable of carrying nearly 5,000 containers, and was returning from a Chinese port. Word on the street is the ship might have been carrying solid rocket fuel precursors for Iran's missile program. This incident followed a chaotic Saturday where Iran briefly reopened the strait only to shut it down again very quickly. 2 tankers reported being hit by gunboats on Saturday, proving the temporary ceasefire was worth as much as any of Trump's promises. Trump has issued a 48-hour ultimatum to Iran to open the strait or face total infrastructure destruction across the nation. We are talking about threats to knock out every single power plant and every single bridge in the entire country. The market's having a bit of a wobbler with these headlines, as the risk of a regional war just went vertical. This isn't just noise, traders. This is a supply chain nightmare that could reshape the global economy for the next year. Let's look at the oil markets, because WTI Crude has just pulled a massive gap-up move this morning. After falling toward $83 last week, WTI has gapped up and opened at $87 today. Some contracts for April 20th are even pushing toward $90.65 as the blockade holds firm. The CBOE Crude Oil Volatility Index, or OVX, is starting to climb again after a brief relief drop on Friday. We saw the OVX peak near 126 earlier this month, and it remains historically elevated right now. Implied volatility in energy options is basically telling us to buckle up for some very wild price swings this week. Trump's threats against Iran's power grid have completely removed the peace premium we saw during the brief reopening. Analysts like Richard de Chazal say this blockade is the ultimate pressure tactic to force Iran to the negotiation table. But for us gold getters, higher oil usually means one thing for the long term: persistent and sticky global inflation. With gasoline and diesel costs surging, the pressure on the Federal Reserve to hold interest rates high is intensifying. Energy stocks like Chevron and ExxonMobil are seeing some serious green as they benefit from the heightened conflict risk. It's a classic risk-off environment where the smart money is ditching growth for hard energy and defensive asset plays. Let's optimize this entry by watching if oil can sustain a close above $90 per barrel this session. Now, let's talk about our favorite shiny metal, because gold is currently the main character in this global story. On Saturday, April 18th, spot gold was sitting around $4,831.23. Despite a minor correction leading into the weekend, the yellow metal has gained over 44% in a year. As the markets opened this Monday morning, gold has been consolidating near the $4,800 mark. We are seeing a bit of a tug-of-war between safe haven buying and some quick profit-taking from the weekend gap. Silver is also putting on a show, recently trading around $80.76 an ounce on Monday. Smart money is noticing that silver has actually been outperforming gold over the last 12 months by a long shot. Silver getters have seen returns of nearly 160%, while gold has only managed 60% gain. Both metals reached record highs earlier this year, and this Hormuz chaos might be the spark for the next leg. The big banks are coming out with some absolutely mental price targets that you need to hear about right now. JP Morgan has lifted their end of 2026 gold target to a massive $6,300. Goldman Sachs is slightly more conservative at 5,400, but they are still very much in the bull camp. BMO Equity Research is the most aggressive of the lot, saying gold could hit $6,500. They reckon gold is no longer just a crisis hedge, but a strategic move away from global sovereign debt risks. While gold is shining, Dr. Copper is giving us a diagnosis that sounds a bit like a pre-market nightmare. The gold to copper ratio has climbed to a staggering 830, a level not seen in 45 years. For the new smart money in the room, this ratio is simply the price of gold divided by the copper price. Usually, a ratio below 500 means the global economy is firing on all cylinders with strong industrial demand. But at 830, it signals that gold is being hoarded for safety while copper is lagging behind. Copper futures are struggling to stay above $6 per pound as manufacturing activity feels the global energy squeeze. Historically, a ratio this high has been a reliable leading indicator for major recessions or massive market corrections. We saw similar spikes during the 2008 financial crisis and the start of the pandemic in 2020. It's a proper warning signal that even though gold is up, the broader industrial world is under major stress. Smelting bottlenecks and mining disruptions are keeping copper supply tight, but demand is the real question mark here. If the Iran war becomes a protracted event, the cost of manufacturing is going to go through the absolute roof. This is a proper golden entry for those looking to hedge against a potential global manufacturing slowdown later this year. Keep an eye on that ratio, because it's often the first thing to flip before the rest of the market follows. This is where we separate the casual traders from the smart money who actually read the macro tea leaves. Beyond the ships and the shells, there is a quieter war happening in the global currency reserve markets. We are seeing a major de-dollarization trend as central banks systematically reduce their reliance on the greenback. For the first time in 30 years, the value of gold held by central banks has surpassed United States treasuries. We are talking about $4 trillion in gold reserves versus $3.9 trillion in United States government debt. This is a seismic shift in how the world's financial institutions view the dollar as a safe haven asset. The United States federal debt now exceeds 120% of GDP, which is making investors nervous. Many nations are looking for alternative payment systems that don't rely on the traditional dollar-based networks. By mid-2026, a huge majority of the G20 will have tokenized cross-border payment systems ready to use. These new digital rails allow for moving money and paying for energy without using any United States dollars. Central banks are also pulling their gold home and storing it in their own vaults to ensure total control. They want physical bars on hand rather than digital promises held in foreign banks during these very uncertain times. The market's having a bit of a wobbler as the dollar index, the DXY, struggles to maintain its global dominance. A weaker DXY makes gold and silver much more attractive for international buyers, pushing prices even higher this morning. This structural shift is a huge reason why the smart money is betting on a long-term bull market for bullion. Let's pivot to the tech world, because the Magnificent Seven stocks are starting to look a bit fragile today. Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla are all facing a rare period of red on the screen. On Monday, April 20th, investors are questioning if the massive AI spending is actually going to pay off soon. We are looking at a projected $680 billion in AI capital expenditure this year alone. Microsoft is down about 17% for the year, and Meta has fallen nearly 34% from its peak. Nvidia, the poster child for the AI boom, has shed roughly $700 billion from its market high. The smart money is worried that we are entering a capital expenditure glut where profits are being eaten by data. Plus, those higher oil prices we mentioned are a huge headwind for tech valuations through persistent global inflation. Institutional investors are starting to rotate out of growth stocks and into sectors like energy and defense. Even the benchmark S&P 500 is feeling the weight, as these 7 giants make up 30%. If tech keeps sliding, gold might become the only attractive play left for those looking for growth and safety. This is a proper golden entry for those wanting to diversify before the AI bubble shows any more cracks. Don't get caught holding the bag if the rotation into commodities accelerates through the rest of the month. One of the biggest distractions in the market right now is the absolute frenzy over a potential SpaceX IPO. Rumours are swirling on Wall Street bets that Elon Musk is targeting a valuation of $1.5 trillion. Some reports are even whispering about a $2 trillion valuation with a $75 billion capital raise. This would be the largest initial public offering in history, beating out the old records set by Saudi Aramco. Traders on prediction markets are already betting thousands on what the ticker symbol will be for the listing. Some are betting on the letter X, while others think SPCX or SPAX might be the winners. Elon reportedly wants to allocate 30% of the IPO specifically to individual retail investors like us. But the smart money is raising red flags, noting that SpaceX's revenue doesn't quite match a $2 trillion valuation. We are talking about a price-to-sales ratio over 100, which is historically very priced for perfection. Even so, the hype is lifting other space stocks and ETFs, like the Procure Space ETF, ticker UFO. It's a classic buy the rumor scenario that is drawing liquidity away from more traditional mining and energy plays. Be careful not to get blinded by the rocket glare. Always keep your eyes on the underlying cash flow. Bringing it all back to the metals, the sentiment in the gold markets remains incredibly constructive this Monday. Fawad Razakzada from investing.com says the path of least resistance for gold is still to the upside. As long as we keep seeing higher highs and higher lows, there's no point trying to pick a top. Paras Gupta from UBP says they are actively rebuilding their gold positions after the recent flush out of one-sided bets. They believe the structural demand from central banks and fiscal deficit concerns are just too strong to ignore. Even if the Middle East tensions ease slightly, the damage to the dollar's reputation has already been done. We are in a regime of lower real yields and persistent geopolitical risk that favours hard assets over fiat. Gold getters. The key is to stay nimble and watch those psychological levels near $5,000 very closely. If we break above $5,000, we could see a massive wave of FOMO buying from the retail crowd. For now, the market's extremely volatile, but that often creates the best buy-the-dip opportunities. This is the time for anyone who missed the initial run-up from the $4,000 level. Watch for where the smart money is flowing at the open of the London and New York sessions. To wrap it up, the US Navy just seized an Iranian ship and the Middle East is on a knife edge. Oil has gapped up to $87 a barrel, while gold is holding firm as the ultimate safe haven. Silver is outperforming everyone, and the copper-gold ratio is flashing a red alert for the global economy. The Magnificent 7 tech stocks are having a bit of a wobbler as AI spending worries investors today. Central banks are moving into gold at record levels, officially holding more value than United States Treasuries now. SpaceX IPO hype is everywhere, with a $2 trillion valuation target making waves on Wall Street bets. It's a high-stakes week, but the smart money is staying calm and looking for those proper golden entries. So, will gold break $5,000 this week, or is the dollar about to stage a shock comeback? Let me know your predictions in the comments, and don't forget to smash that like and subscribe button. Let's see where the smart money flows next. Keep your eyes on the chart and your heart in the game. Keep your positions tight and gains golden. I'll see you at the next close. Cheers.